Welcome to the Unbiased Advisor Podcast, where we explore investment themes and insights for investors and financial advisors alike. The views expressed are intended solely for informational purposes and should not be construed as investment advice and are not meant to be a solicitation or recommendation to buy, sell, or hold any securities mentioned. Please stay tuned for additional disclosures at the end of the podcast. Today on episode 4, recorded on March 16th, 2021, we have Adam Butler of Resolve Asset Management. We discuss Resolve's paper entitled Portfolio Optimization for Efficient Stock Portfolios. Please enjoy our discussion with Adam Butler. Adam, thanks for joining us today. I appreciate the time. I'm going to be talking about your paper that you wrote at Resolve Asset Management, Portfolio Optimization for Efficient Stock Portfolios. But before we jump into that, can you kind of just give us a quick background about yourself?
Sure. I started as an advisor in Canada for wealthy families. And over my trajectory as a wealth advisor, I met my partner, Mike Philbrick, who was the branch manager at a large advisory firm in Canada. And over a couple of years, it became obvious to us that we would be able to form a really effective partnership. And we founded Resolve Asset Management in 2015 to realize that vision. And the focus of Resolve is primarily on global asset allocation. And we are entirely systematic, which just means that we don't rely on stories or even stories that are informed by data to create portfolios, but rather we rely on historical statistical relationships and irreducible or indelible mathematical truths about the way that random variables or random market moves can work together in creating more efficient portfolios at the global asset class level across 70 or 75 different futures markets or using different ETFs. And we've also, as we're discussing here today, applied some of this thinking to how to create efficient portfolios of equities as well.
Very good, very good. And I think how big is the firm at this point, Adam? Not AUM wise. I'm sorry, say that?
About 300 million in AUM across. Okay. We've got 40 Act fund in the US and a publicly listed ETF in Canada, as well as several performance funds with feeders in both the US and Canada and offshore. We also run SMAs for individuals using ETFs and a fairly traditional wealth practice in Canada.
Okay, that's great. And you how many employees you guys have now?
15.
15, yeah. So slowly expanding for sure. Six years in roughly at this point. Yeah, very good, very good. So yeah, I'm gonna jump into this paper that you guys wrote on your website. Just a quick plug: resolveassetmanagement.com. Is that correct? The website?
It's investresolve.com.
Investresolve.com, and you guys have blog posts, white papers, research papers, and then you also have this podcast that you guys have. I tell whoever's viewing this to go check that stuff out. They have some great things on portfolio asset management, like you're saying, global portfolio allocation. But diving into this specific paper, Adam, a couple things kind of jumped out at me. First, you said, there has never been a more urgent need to fundamentally explore the concept of passive investing in the market portfolio. And then you go on to say that the market cap weighted portfolio is shockingly inefficient to other reasonable alternatives. Can you dive into that and maybe explain where you're coming at with that those two sentences?
Sure. Yeah. So the cap weighted portfolio was first proposed by Sharpe in a paper in 1962. And he built his thesis from the bottom up, starting with the idea that markets were perfectly efficient. And if markets are efficient, it means that current prices and or therefore valuations of companies reflect all available information in the markets, and therefore agents who are competing to outwit each other in terms of pricing these securities appropriately will converge on the most efficient, accurate price or valuation based on a mosaic of all of these different sources of information. The average is going to be correct.
Sure.
And if that's true, then the market portfolio, the cap weighted portfolio, is in theory the most efficient portfolio because it is holding all markets at their appropriate level of valuation. And a corollary to that, and I'm not going to get into the derivation of because you've got there's a utility function in the middle there, but assuming reasonable utility function, in other words, basically that if somebody has $1 million in wealth, then an extra $1,000 in wealth is worth less to him than somebody who has just $1,000 of wealth, right?
Sure.
So you have $1,000 of wealth, an extra $1,000 is worth a great deal to that person.
Yep.
And so if you assume that basic utility function, then the mean variance optimal portfolio, another the portfolio that delivers the highest expected return per unit of risk, where risk is measured in volatility, is the cap weighted market portfolio.
Yep.
And if that's true, then every stock in the portfolio should have a return that is a commensurate with its beta to the portfolio, and where beta is just the degree to which a stock co-varies with the movement of the market. So for example, a high beta stock, if the market goes up by 1%, the high beta stock might go up by 1.5%. If it goes down by 1%, the high beta stock may go down by 1.5%.
Sure.
Or a low beta stock, which has a low co-varies it to a lesser degree with the movement of the market. The market goes up by 1%. Maybe that stock only goes up by 0.5%, but commensurately it'll only go down by 0.5% if it drops by 1%. So this is the fundamental relationship that I'm trying to dig into in this paper, because if you examine the actual historical relationship between a stock's beta, so let's call that its riskiness, and its subsequent returns. Well, CAPM, through a series of logical axioms, implies that the return, that high beta stocks should have higher returns. And what you observe in the historical sample is, in fact, that high beta stocks do not have higher returns than low beta stocks. In fact, you can make an argument that low beta stocks have higher returns than high beta stocks in the historical sample, which flies in the face of CAPM and therefore flies in the face of principles of market efficiency. And so that's really what we dug into in the paper.
Okay. So yeah, you broke down CAPM as, this axiom, like you said, on high beta outperforming essentially according to the formula, right? Now you then go into evaluating different portfolios or portfolio construction processes on the equity side, right? Can you go through maybe a couple of those portfolios and what I'm really interested on how you came up with these different set of portfolios that you guys try to test out against the market weighted portfolio.
Sure. Well, I want to add that our paper was very derivative. In other words, there's nothing novel in our paper. What we did is sort of consolidate the research that a variety of other professionals have already documented, right?
Sure.
But the fundamental premise for the portfolio construction methods that we describe in the paper is predicated on one major fundamental assumption that I think many investors do not yet espouse, and that is that stock picking is hard. Like, it's really hard to be able to look at a cross section of all of the different stocks that are available for investment, and based on some kind of fundamental factor or technical factor or what have you, isolate ones that are likely to do well against ones that are likely to do less well. And so if you can't, if it's very difficult to to stock pick, to choose stocks on the basis of fundamentals or some other technique, one stock at a time, then an alternative to that is to have some sort of fundamental model for what to expect in terms of stock behavior, right?
Okay.
So as already mentioned, the CAPM, and why everybody sort of talks about the cap weighted portfolio as kind of being the market portfolio, or, implicit in that is the most efficient portfolio for investors to own, is this relationship that implies that expected returns are a function of the beta of a stock to the market, right? And so this is a model, right? We're not doing any sort of fundamental analysis on individual stocks at all. We're just sort of saying across all stocks, those stocks with higher beta have higher expected returns, and those with lower beta have lower expected returns. And if that's true, and the fit is reasonably strong on this model, then the cap weighted portfolio is efficient, right?
Okay.
But that's not the only model that you can use. You could say, for example, that a portfolio, that a stock's volatility itself, so not its covariance with the market, but just its volatility, is proportional to its expected return. So high volatility stocks have high returns, low volatility stocks have low returns. And if this relationship holds and is relatively tight, then there's a different portfolio that represents the most efficient way to construct or put stocks together, and that's the maximum diversification portfolio. And that's really just saying that a stock's expected return is proportional to its volatility, and then performing a traditional mean variance optimization or max Sharpe optimization. And then another assumption is just that there is no relationship between a stock's risk and its return, right? So higher risk stocks and lower risk stocks all have the same return. There's no information there. And if all stocks have the same expected return, then the most optimal portfolio is the minimum variance portfolio, because all stocks have the same expected return. All you want to do is find the portfolio that minimizes total portfolio risk, right? That's pretty intuitive. So these are three common models that obviates the need to select individual securities or derive some method of expressing the expected return for each individual security based on some fundamental set of principles, right? And in doing so, there are statistical reasons based on shrinkage and regularization and that kind of stuff that we probably don't want to go into. But there are reasons why these model-based approaches are likely to be more robust than methods that rely on picking individual stocks.
Okay. So when I looked at the models, one of the things I thought was interesting that was missing was maybe like factor style models. I know you had low vol as one of the models you tested. Some people might say min variance is a model, but I didn't see anything for your traditional, FAMA French value small cap. Why didn't you guys test those out as a representative market portfolio?
Well, a couple of reasons. One of which is that we wanted to focus on investable securities. So we only used stocks that were the top 1,000 by market cap. So that we could ensure that all of the securities were available for investment by large institutions, because we wanted to make this realistic. And so it didn't make sense in that context to divide it into small and large, because we really only wanted to focus on large and investable, right? Or investable at scale. Because what we're trying to do is sort of provide a framework for how to think about a market portfolmore investment. Right? So if you're just focused on small caps typically represent, a vanishingly small fraction of total market cap. So it's more of a idiosyncratic factor than it is trying to construct a market portfolio. The other reason is that we wanted to just isolate the common models for how to think about relationships between risk and return. And factors are really active views, right? You're trying to really actively bias portfolios towards stocks with high book to market or high earnings to price or high momentum or what have you, which ends up being an active bet. We do have research that does combine some factor models with optimization. So for example, using momentum decile for expected return in a mean variance optimization, right? So you're maximizing the expected return while simultaneously minimizing variance, or using residual momentum, that sort of thing. And those do historically have done quite well. As a bit of a sidebar, one of the prominent academics, Liu Zhang, has recently made available a database of a very large number of historical return series for a wide variety of factors. I think there's 160 odd factors across 6 or 7 different factor families, including sort of momentum and value and investment and ROE and
Quality,
liquidity. There's a few of them.
the
Quality,
factor zoo, so to say.
Yeah.
Yeah.
So, and you can download a historical time series for like a daily scale for these factors, and which allows for some really interesting analysis.
Yep.
Something that we just recently looked at was, can you look at, and it goes back to 1960s with all of these, or a vast majority of them, call it like 130 of 160 or something, go back a really long way. And we were just wondering whether you can use the sort of historical performance of different factors to select the factors that are most likely to deliver the best performance going forward. And what we found was that using, for example, the T statistic of the Sharpe ratio or compound returns or what have you on these different factors doesn't give you any information about which ones are more likely to perform going forward. And in fact, if you take the top 10%, 20%, 30%, 50%, et cetera, of factor series that had the highest T-stats coming into 2010, the performance of every portfolio was essentially flat. I mean, there was just no way to select. So this sort of method of trying to choose factors, the problem is, and this is probably a little off-roading for this conversation, but the problem is that empirical finance is using an approach to statistics that is descriptive rather than prescriptive. And it doesn't actually give you the information that you need in order to decide which active views you want to take in the future, right? Which is why this is so different. The framework that we proposed here is so different, because we're not prescribing any sort of active view. We're sort of saying at the most fundamental level, what model of risk and return seems most likely from what we observe in the historical data. And what we sort of conclude is that stocks don't really seem like they have any relationship between risk and return, and therefore the minimum variance portfolio is likely to be the most efficient portfolio. But that you have to make some sort of active view. Even CAPM investors are taking the view that the market is perfectly efficient at all times, right? And so you have to take a view, which is what active view do you want to take? And some active views are much more active than others, right? So factor-based views are much more active than risk model-based views. And I think that's the basic premise.
Yeah, that's very, so it sounds like what you tried to do is take out the regime of trying to pick, like the active thing is, hey, I can take a look at the regime because certain factors perform better in different types of regimes, right? But we don't know what regime we're going into. So you said, look, we don't care about regimes. So what we're trying to do is just figure out the relationship between just the risk and return, essentially. Is that correct?
I think what I'm saying is sort of two things. One is choosing the factors to emphasize in the portfolio in advance based on historical data is really hard.
Okay.
So
because you don't know how that's going to regime wise.
There's no good answers to that.
Yeah.
So it's less sort of regime based and more just deciding which factors to emphasize in advance is hard. So I'm going to leave that aside because it's hard.
Right.
And I'm going to instead focus on something more fundamental, which is just, you literally cannot invest in a stock portfolio without having some kind of fundamental risk return framework.
Yeah.
Unless you're literally choosing stocks exclusively based on their fundamentals. And even then, you've got to express views about covariance. If you're going to hold them in equal weight, then you're saying that they all have the same, their pairwise covariances are all equal, right? That's a view. So no matter what portfolio you construct, you're having to take a view.
Right.
It's just how active is that view? And so we're sort of focused on, in this paper, the set of decisions that is least active, and trying to leave aside some of the other ones.
So you guys have a paper that you wrote, I think maybe 2 or 3 years ago. I don't know how long, but it walks you through. If you have a view on this, you go to nod A. If you don't have a view on this, you go to nod B, and you take this flow chart out, and then it takes you into these different portfolios, right? One being, min variance. Then you have, I think equal weight is a big portion of that, right?
Yep.
Max diversification. So that's really what you're kind of teasing out then, it sounds like, right? Is where do you want to take your active bet, so to say, or your active view? And based on that, that's where you end up into these different portfolios. Is that a fair assessment?
Yeah, everyone needs to decide what relationship between risk and return they think exists and what they know, right? You've got a model, and then you've got what you can estimate. So if you think that risk is proportional to volatility, but you don't know how to estimate volatility, then that's kind of useless.
No good. Yeah.
Right. And so you would sort of say, well, I can't estimate volatility, and so I need to use a model that doesn't require me to estimate volatility. So maybe I would use equal weight, or I would use cap weight, because they don't require any sort of estimate. Right. So you need both a view and the ability to estimate the parameters that inform that view in order to have the appropriate portfolio construction method.
So to kind of conclude, what did you get out of all of that analysis?
Sure. Well, so some simple things. First of all, there was a really great paper by Cass Business School a few years ago, and they performed a simulation where they did random draws of securities each year. So the available securities each year, formed a portfolio, and then drew another random portfolio the next year of the available stocks the next year. And this is all large cap stocks. So top 1,000 by market cap each year. And they did this thousands and thousands of times, and they generated this sort of random portfolio performance distribution over the period. I think it was from 1960 to maybe 2010 or something, and maybe 2015 or something like that. And then they plotted the performance so you've got this sort of this distribution of all these equally weighted portfolios.
Yep.
And then another, here's the cap weighted portfolio performance.
Okay.
And the cap weighted portfolio was at like the first percentile. In other words, 99% of all random equal weighted portfolios outperform the cap weighted portfolio. So there's an extremely high probability. Now keep in mind, the challenge with this, of course, is that it's a 60-year, or call it 50-year sample.
Yeah.
Right?
Yeah.
So in any sort of 3 or 5 or even maybe even 10-year period, the cap weighted portfolio could outperform. Right. And this is one period. The last 10 years is happens to be an example of where the cap weighted portfolio completely dominated. Right. Yep. But the probability of that ex ante, in other words, if you had to go back to 2010 and sort of decide what's the high probability bet here, the high probability bet would be to own the equal weight portfolio, right? Because it just dominates so dramatically on average over time. But you do run the risk of underperforming if you do that. And everyone hates to underperform.
Even in a day time frame now, we've chopped it all the way up to a day. Soon it will be an hour probably. How is the fun meme stocks doing versus my retirement portfolio? But anyways, sorry. So
it's an impossible challenge. We face this too. I mean, if you're observing your portfolio at any more regular interval than every 5 years, all you're observing is noise. And arguably 5 years is too frequent, because the noise is far, far too too large relative to the signal for you to give you any information. I mean, we just talked about evaluating factor strategies all the way back to 1960 to 2010.
Yeah.
And the performance of those factor strategies gave you no information about which ones are likely to perform in the next 10 years. Zero.
Right.
So, you have no information. All you have is sort of a belief system. And what we sort of went through in this paper was, without sort of starting with backtesting, because you really can't derive much information from backtesting, right? Like all these individual factor series had this wide dispersion of Sharpe ratios. Some had like a Sharpe of 3 or 4, or a t-stat of 3 or 4, and others had a t-stat of like 0 or 1. And that gave you zero information, even though it was like 40 or 50 years of data. Right?
Yep.
So you've got to sort of dig deeper into what are the fundamental relationships we're evaluating, right? And we looked at what is the relationship between if a stock is in the bottom decile by beta in this period, what is its return in the next period? And second decile, what is so you've got to go through this type of analysis and see whether the fundamental principles hold. And what we observe is that, there's no relationship between the beta of a stock in this period or next period and its subsequent return. So the fundamental assumptions underlying cap weighting and CAPM are broken.
Yep.
What do we observe? If anything, there's an inverse relationship, but that seems so absurd that we sort of said, well, let's take the neutral ground. We can't statistically significantly reject the hypothesis that there's no relationship, right?
Okay.
It's the negative relationship is not strong enough for us to reject the hypothesis that in fact it's just zero. And so if you choose that, the minimum variance portfolio is the most efficient way to construct stock portfolios. And that's what we also observe. Even still, the empirical confidence that you get, because all of that is in sample, is relatively low. The primary source of confidence is in observing the empirical relationship between risk and return. There is no relationship, and therefore we expect the minimum variance portfolio to outperform regardless of performance. It was convenient that the performance of the minimum variance portfolio dominated the performance of the other portfolios to such a meaningful degree from a statistical significance standpoint. But that was more incidental or just confirmatory than actually the strongest source of evidence.
Yeah. So you guys, so min variance, you did something interesting. I thought you capped, certain position weights, right? I think 1.5, maybe 3 and 5%. Why did you guys kind of think about that? Was it because when you just ran the min variance portfolio, you were getting massive amounts into one sector or one stock or something like that, so you decided to bring it down a little bit? Or what was the thinking behind that?
It's really to make it more investable, because sometimes you get fairly substantial weights in certain stocks.
Okay.
And so we just thought to make it more investable, and also to sort of see the sensitivity of the strategy to these types of constraints. And I was pleasantly surprised to see how resilient the performance was to even fairly severe constraints.
Yeah, for sure. And then the other thing, I don't think you jumped into the paper so much, but something I was curious about is I think on the last two, or, kind of the summation pages, you talked about the drivers of the economic drivers of the portfolio, right? One of the other reasons people might gravitate to market cap weighted is, hey, I have exposure to all the drivers of the economic engine. But you were able to show that min variance actually has more economic drivers than the market cap weighted portfolio. Could you maybe kind of sum up or describe how you came to that conclusion?
Yeah, absolutely. So it's possible to measure the number of independent sources of risk in a portfolio. And it's really a function of the correlations between different stocks, right? So if all the stocks are very highly correlated, then they represent really just one bet, right?
Yep.
If you've got a lot of heterogeneity in the correlations, then you've got many different segments of the market that are behaving in different ways for different reasons.
Okay.
And you can measure the degree to which we do observe this heterogeneity by using something called the diversification ratio. And the diversification ratio is a function of both the diversity that is available in the market and how well you're taking advantage of that diversity, right? Which is in terms of like your portfolio weights. And so if your portfolio weights have you concentrating in a variety of stocks that are actually really highly correlated with one another, then you're not taking advantage of that diversity.
Right.
The most diversified portfolio is the max diversification portfolio.
Yep.
Right.
Yep.
That gives you exposure to the most bets in the portfolio, but it also leans into the view that a stock's expected return is commensurate to its volatility, which empirically we observe to not be the case. So the minimum variance portfolio is a nice balance between the cap weighted portfolio and the max diversification portfolio, because it does seek to minimize the volatility of the portfolio by taking advantage of diversification, but it doesn't lean into the view that return is commensurate with risk. It preserves the empirically observed view that returns are not linked to risk whatsoever.
Right. Very good. Yeah, I thought the paper was excellent, and I would tell the viewers to go check it out. Just to kind of leave off on a couple last questions for you, Adam. Again, thanks for your time. One of the things I ask all the clients or all the people that come on the show is what's grabbing your interest right now as far as like either research topics or things that are going on in the markets, or I know NFTs are a big thing and all that stuff. Is there something that you're gravitating towards right now as far as research and thought process?
Yeah, all of the thinking that we have moved to in the last 2 or 3 years is informed by the applied statistics and machine learning literature.
Okay. Yep.
And it's just incredibly eye-opening. All of the, like I said, this idea of published empirical finance being descriptive but not prescriptive is so fundamental to the problem faced by investors and advisors and investment boards. Everybody makes decisions, or not everybody, but the vast majority of professionals make decisions based exclusively on in-sample information and have no idea about how informative that in-sample information is for forecasting what's going to happen in the future. And so we spend all our time trying to derive tools that allow us to determine which edges or which methods are not just descriptively significant, but also allow us to be prescriptive about which different factors or edges or portfolio construction methods or risk management techniques, et cetera, are more likely to be robust or resilient out of sample across different market regimes, that sort of thing. So we're head down in that problem. And honestly, that problem has endless dimension. It is absolutely fascinating. No matter what steps you take to try to reduce bias, those steps introduce different forms of bias that you need to control for. And so it's just been a really fascinating journey, but the more we learn about trying to forecast markets, the more we realize how little we know about how to forecast markets and how to make good choices. And it's just a really hard problem and fascinating.
Well, it's a hard hill to climb, right? The bias framework, with clients in general, the recency bias kicks in. I think that's what you were touching on, the recent in-sample returns. Hey, Tesla, or, the EV company has done so well, we should be riding this wave up, when a lot of the data probably says that's not the right thing to do, or at least the future returns have been reduced because it's all been pulled forward or what have you, basically. Right. So that's interesting.
It's a good point. I mean, and what happens, of course, as you've observed, no doubt, is that clients observe recent performance and then they pile into the things that have done well, which, if they were to apply a systematic process that continues to rotate into the things that have done well on a regular frequency, sort of monthly or quarterly in the equity markets, for example, then that method actually might do okay.
Yeah.
That's momentum.
Yeah.
The problem is when you sort of chase into something that has done well and then you ride it down, right? Because you're sort of locked in and you don't want to lock in a loss, and you've got all these cognitive biases that are working against you in decision making, which is why we do everything systematically to sort of do our best to short circuit some of those cognitive and emotional biases, which confound so many investors.
I'm sure, yeah, you guys have been exposed to, investors knocking on the door as to why you're doing what you're doing, even though you've explained it many times that this is in the long run probably the best thing. But it's counterintuitive to a lot of people, mainly because of the biases we hold, right? Anchoring bias, recency bias, reflection, whatever it is. It's kind of hard to overcome. All right, last question for you, Adam. What has colored your theory or your view of the markets and investing in general? So what I mean is, did you read a book? Did you have a mentor? Did you follow a line of thinking that kind of colors the way you see the markets in general?
Yeah, I mean, it was, I had a very terrifying experience in 2008 when it seemed like the financial system may not recover from that crisis. And it prompted me to think differently about investing in general. I was running primarily a highly concentrated stock portfolio. And so it caused me to move far more into asset allocation and to start thinking about things systematically. And I mean, I keep recommending this to people. I know a small fraction of people take my advice, but perhaps the most influential book I ever read pertaining to investing, but also just virtually every dimension of a person's life, is called Expert Political Judgment by Philip Tetlock. And where he basically demonstrates that in complex fields, it is impossible to forecast using the tools that are at our disposal as humans and our wetware. And it was complemented by Fooled by Randomness and The Black Swan by Nassim Taleb.
Yep.
But then to an equal degree by a book called Behavioral Investing by James Montier. So if you can read those three books cover to cover and really internalize the messages there, which are going to be very, very uncomfortable for most people, because you really realize you have no control over most things, then I think you're well on your way.
Well, thanks for the time, Adam. Can you really just, again, for the viewers, just spat out the website and maybe where people can tag you on Twitter or LinkedIn or whatever your monikers are?
Yeah, great. So encourage you to visit investresolve.com. We have a weekly live broadcast called Resolve Riffs every Friday at 4 p.m. Eastern Time. So you'll find links to that. We also have the Gestalt U podcast, GESTALTU podcast, which you can find on any podcast platform and also on the firm website. I am at Gestalt U on Twitter. And we've also got a variety of white papers on asset allocation, retirement strategies, optimal portfolio construction, behavioral biases, you name it. We cover a wide range of different topics on the website. And we've got a blog that we've been writing since 2009 with over 200 articles on it. So and we just launched a Resolve Masterclass aimed at sort of ultra high net worth investors that are thinking about their wealth in a multi-generational context, so over many decades, and what to think about there and how to think about building optimal, sustainable portfolios that are resilient to every conceivable economic regime that we might encounter over a many decade investment horizon. So I encourage you to check that out too.
So is that like a sign up class, or is that going to be on YouTube, or how's that?
It's on the website. It's also, you can find it on just, if you Google Resolve Masterclass on any podcast platform.
Perfect. Thanks for the time.
It's also on YouTube, I think.
Okay. All right. Thanks a lot, Adam. I appreciate it.
Appreciate it, Chris. Thanks so much. Great questions. And it was fun chatting.
Adam Butler and Resolve Asset Management, Engage Financial Group, and Woodbury Financial Services are unaffiliated. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting professionals before engaging in any transaction. Securities and investment advisory services offered through Woodbury Financial Services, member FINRA, SIPC. Woodbury Financial is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Woodbury Financial Services. Past performance is not a guarantee of future results. Information presented herein is for discussion on illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Views expressed are as of the date of the recording based on the information available at that time and may change based on market and other conditions. Although certain information has been obtained from sources believed to be reliable, we do not guarantee its accuracy, completeness, or fairness. We have relied upon and assumed without independent verification the accuracy and completeness of all information available from public sources. Investing involves risk. Loss, including loss of principal, may occur. No investment strategy can guarantee positive results. Investors should be aware that investing based upon strategies or models does not assure a profit or guarantee against loss. This material contains forward-looking statements and projections. There are no guarantees that these results will be achieved. It is our goal to help investors by identifying changing market conditions. However, investors should be aware that no investment advisor can accurately predict all of the changes that might occur in the markets. Krishna Patel, CFA, is an investment advisor representative at Woodbury Financial and can be reached at 317-489-3505 or kpatel@engagefingroup.com and located at 11622 North Michigan Road, Zionsville, Indiana 46077.